Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Atlanta, Nashville, Charlotte. 3 weeks ago, all three were printing positive year-over-year home price growth. That's the price today versus the same month a year ago. The April data hit, and all three crossed into negative territory. They joined 86 other metros. Total, 89 of America's 300 largest markets now in the red. The headline number for the country is plus 0.8%. Boring, almost flat, but the country isn't a country here, it's two countries. Hey, Prime investors, Martin Maxwell here. Welcome back to the 5-Minute Prime Podcast. The data behind today's episode came out April 18th. Lance Lambert at Resi Club Analytics, tracking the bifurcation. If you're actively underwriting a deal in any Sunbelt metro right now, the next 6 minutes change your math. Let's go. What the three flips mean. Atlanta, Nashville, Charlotte. Three of the strongest Sunbelt narratives of the last cycle. Institutional money said these were the safe bets, the ones with diverse employment, the ones that wouldn't crack the way Phoenix and Austin already had. The latest monthly metro level home value data, published April 18th, says they cracked. Atlanta's down 3.8% year over year. Nashville down 3%, Charlotte down 1.3%. None of those are crash numbers. They're crossing zero numbers. And the crossing zero set is the one that matters. Here's why. When a metro flips from positive to negative on year-over-year price growth, you're watching the demand-supply equation invert. Whatever propped up that market, in-migration, builder restraint, employment expansion, is no longer enough to clear the inventory. The market doesn't crash. It softens, and the softening compounds for 2 to 4 quarters before it stabilizes. That's the historical pattern. So if you're underwriting a deal in Atlanta or Nashville or Charlotte this week, the question isn't, is the deal good against last year's comps? The question is the deal good against the comps it'll have in October? Different math. Quick empathy beat. If you closed in Phoenix or Tampa in 2024, this isn't bad news for you. This is the math of why you bought there in the first place. The exit window just got longer, the cash flow is unchanged. Hold position, ride it. But for new acquisitions in those metros, the underwriting has to bake in a depreciation tailwind for the next few quarters. That's what the three flips are telling you. The 89 and the trajectory that changes the story. Now drop the framework around it. Back in episode 120, the first week of April, we called this the two-speed market. The data then showed a clear divergence. Midwest and Northeast metros appreciating, Sunbelt growth corridors cooling. Some of you emailed me and said I was overstating the split. 6 weeks later, the data is sharper. Resi Club's running count of 300 large metros. In January, 106 were YoY negative. February, 99. March, 89. Read that again. Falling, not crashing, finding the floor. Lambert's read is that the bifurcation is structural, not panic. The Sunbelt softening is finding its bottom. The negative metro count is narrowing, not widening. That's the part the doom headlines are missing. Here's the cleanest single fact for the bifurcation. Hartford, Connecticut. Median days from listing to pending offer, 11. Austin, Texas, 82. Same week, same country. Hartford homes go pending in a week and a half. Austin homes sit for nearly 3 months. Austin is 27.8% below its 2022 peak. Hartford is 22.5% above its 2022 peak. That's not a single national market having a moment. That's two markets pretending to be one because the press release writes the headline that way. If you read this week that the housing market is finding balance, the Florida Realtors piece, the National Mortgage Professional piece, the Zillow press release, you read it wrong. There's no housing market singular. There are at least two, plausibly three when you add the Pacific Northwest. The 89 to 300 split is the cleanest way to talk about it. Call it what it is, the disappearing national market, the version of U.S. housing where one number, one mortgage rate, one HPI print, one days on market average meant something for an investor in 2019. That version is gone. There are regional housing markets now. Read regional data or you're reading static. Why the split persists? Two structural drivers. Oversupply on one side, underbuilding on the other. Sunbelt oversupply is the dominant driver. Lennar reported in their last quarterly that builder incentives are running at 13.3% of sale price. Highest level since 2009. New single-family inventory, 499,000 homes. Months of supply stuck above 9. That's a buyer's market by any standard. Builder unsold completed inventory just hit the highest level since 2009. 11 states states are above their pre-pandemic 2019 active inventory level. Arizona, Colorado, Florida, Idaho, Nebraska, Oklahoma, Oregon, Tennessee, Texas, Utah, Washington, read that list. Every Sunbelt growth corridor on it. Now the other side. Midwest delivered roughly 12,100 multifamily units in Q3 of 2025, the only U.S. region below its 10-year average build pace. Active inventory in most of the Midwest and Northeast is still well below pre-pandemic 2019 levels. Two markets running on opposite supply equations. And institutional capital sees it. PwC and the Urban Land Institute's 2026 Emerging Trends Outlook, the Bible for institutional real estate allocators, moved supply-constrained Midwest and Northeast metros up its rankings for the first time this cycle. The smart money isn't running to Phoenix anymore. The smart money is reading the 89 to 300 split. And here's the rate context, because somebody's going to ask. Fred's 30-year mortgage rate as of April 23rd, 6.23%, down from 6.3, down from 6.46 earlier in the month. Rates are softer than they were when we recorded EP 120, but the rate-sensitive Sunbelt buyer pool is not responding. Affordability damage from the 2022 to 2024 price spike, plus the supply glut, overwhelms the rate relief. That's the point of view. In this cycle, supply is the dominant variable, not rates. If you're modeling Sunbelt acquisitions on the assumption that rates come down and demand comes back, reread the inventory data first. Here's your challenge today. Pull up the buy box you're actively underwriting. Cross-check every metro on it against ResiClub's 89 metro negative list. Link in the show notes. For any metro that appears, run the deal at 3 percentage points higher cap rate than your hurdle. That's the rough adjustment to compensate for a depreciation tailwind in the holding period. Call this the +3 rule. Quick math to make it real. Phoenix duplex listed at $250, projecting $1,850 in monthly rent. That pencils to a 5.5% cap rate. Eyeballed. Cap rate is your unleveraged annual yield, the property's net operating income divided by purchase price. 5.5 looks decent on paper, but Phoenix prints minus 2.7 YOI, so you're underwriting against a property losing 2.5 points of value per year while you hold it. Add the +3 to your hurdle. Now you need 8.5% cap to break even on the depreciation drag. Phoenix at 8.5% cap doesn't exist this year. Compare that to a Cleveland duplex at 180, projecting $1,550 in rent. Same math comes out at almost 7% cap, plus an appreciation tailwind. Same dollar of equity, two structurally different outcomes. That's not a deal, that's a donation. EP 120 quote still true. If your deal still pencils after the +3 adjustment, fine, proceed with eyes open. If it doesn't, you've got a decision to make this week, not in Q3. Back in episode 112, I told you about the Tier 2 Trinity, Cleveland, Birmingham, Kansas City. The April data is the proof of work on that thesis. The blog Tuesday goes deep on the 3 Tier 2 metros that just printed clean spring numbers. That's the next piece of homework. Thursday, episode 131, we break down what landlord insurance is doing to the cap rate math in 2026. Florida policies are now running double what they did in 2019, and that's the variable that turns the +3 rule into a +5 rule for storm state holders. Stay with me. I'm Martin Maxwell. This was the 5 Minute Prime Podcast. Read the data, not the headline. See you Thursday.